Hello, everyone, and welcome back to Gold Off the Charts. In a market this volatile and full of smoke and mirrors, we don't just watch the show, we look for the real mechanics underneath. A little bit of deep financial insight every day will help you see further, walk steadier, and survive longer than the rest on your journey to building wealth. I know the last couple of days have been heavy for many of you, and some might even be losing sleep. If you've been glued to the charts lately, I'm sure your heart rate has been through the roof. Over the last 48 hours, the global markets hit a historic liquidity shock. Let's look at the numbers first so you can really feel the scale of this storm. It wasn't long ago that spot gold was sitting pretty above 5,000, a level that felt untouchable, like gold in our hands could never lose its shine. But in just 2 days, it's as if gravity suddenly kicked back in, or an invisible giant hand slammed the price down. From the highs on February 4th, it was a straight line down to the February 5th lows. Gold dropped 1.84% to hit $4,684.71 an ounce. Everyone, this isn't just a 3-day low. It's much bigger than that. We're talking about a cumulative drop of over 5% in just 2 trading sessions. For a safe haven asset that usually moves slowly, a crash like this is catastrophic. It wipes out leveraged traders in an instant. If you think gold was intense, silver was basically skydiving without a parachute. Spot silver didn't just break below the psychological $70 mark. It tanked about 8% during the session, hitting a low of $64.73, a level we haven't seen since December of last year. What's behind that number? Total account liquidations and a massive blow to investor confidence. In just 2 days, silver has lost over 25% of its value. 25%, guys! To put that in perspective, in the futures market, if you were using even 4x leverage, which is actually quite conservative for futures, your entire account would have hit zero in 48 hours. As I record this, the market is catching its breath, with both gold and silver seeing a tiny bounce after the bloodbath. Gold is currently fighting to stay above 4,800. Silver managed to claw back the 70 level for a moment, but everyone is still on edge. But people don't make the mistake of thinking this is just a gold and silver problem. If you zoom out and look past precious metals, you'll see something even more concerning. This crash wasn't an isolated incident. Almost every asset class except the US dollar faced an indiscriminate, panic-fueled sell-off last night. This was a global asset execution. It's a liquidity black hole. Just look at the crypto market. Bitcoin, which many called digital gold, was supposed to be the hedge against failing currencies. Instead, it took the brunt of the storm, proving even more fragile than tech stocks. Bitcoin tumbled 12% on Thursday alone. The price accelerated down to the $63,000 range, hitting a 16-month low. Let's remember that since the peak in October, Bitcoin has now dropped more than 48%. We're basically back to October 2024 price levels. Think about what that means. It means 6 months of gains vanished into thin air, and all that time spent waiting and holding was for nothing. Bitcoin's total market cap has also shriveled up. It went from a peak of $2.48 trillion and got cut nearly in half to $1.27 trillion. The global flight from risk has forced the world's biggest crypto into a nasty downward spiral. This is a total massacre. Data from CoinGlass shows that in the last 24 hours, over $17 billion in long positions were liquidated across the crypto space. Around 400,000 traders saw their accounts wiped out overnight. Their wealth was deleted. What does this tell us? It tells us that Bitcoin's reputation as a safe haven is being tested like never before. When a real liquidity crisis hits, it trades more like a high-risk tech stock than a stable gold bar. When the tide went out, we saw it wasn't wearing any safety gear. Speaking of tech, let's look at the U.S. stock market, the command center for global pricing. It took a massive hit last night as well. Both the S&P 500 and the Nasdaq fell to fresh lows, specifically targeting the once invincible tech sectors. All 3 major indices dropped over 1%, and the Russell 2000, which tracks smaller companies, fell 1.8%, showing that the pain is spreading across the whole market. 9 out of the 11 sectors in the S&P are in the red. Software ETFs alone dropped 5%. Individual stocks look even worse. Oracle fell nearly 7%, Microsoft dropped almost 5%, and Amazon tanked 10% after its earnings call. The big tech giants are all under fire. Why? Because the market is spooked by the massive increase in AI spending. Investors are worried these multi-billion-dollar bets won't pay off anytime soon. There's even fear it might cannibalize traditional software sales. The AI hype, which was last year's biggest engine, has become a weight around the market's neck. This leads us to a key bit of market logic. In a sell-everything environment, many institutional investors hit margin call pressure. You might know the term margin call. When your stocks lose value and your broker demands more cash to keep the trade open, but your pockets are empty, what do? To save their accounts from being forced closed, hedge funds and big traders have to sell whatever they can. They have to dump their most liquid assets to get that cash. And what are the most liquid things you can sell besides US dollars? Gold and silver. That's why the metals are being guilty by association. This forced selling is clear in the metals market. Silver, with its higher volatility and leverage, is usually the first thing to be sacrificed. Analysts are saying it clearly. The fundamentals haven't changed, but investors are being forced to sell their metal positions to cover stock losses. Please take a note of that. It's the most important thing you'll hear today. This sell-off is a liquidity stampede, not a rejection of gold's value. There is nothing wrong with gold's long-term story. In fact, there wasn't even any specific bad news for gold. But when you look at the charts, it's terrifying. Those big red bars look like waterfalls. It makes people panic and dump their holdings at any price, regardless of the value. But history shows us one thing. Once the cash starts flowing again, those who panic sold usually end up full of regret for selling at the bottom. That's just human nature, and the cold reality of the markets. So, we have to ask, why did the mood and the money supply shift so fast? Where did this storm start? Who knocked over the first domino? There are two main triggers and one big psychological game at play. The first trigger was the US jobs report. It was a direct hit to the fantasy that the US economy is bulletproof. The job market is having its worst start since the 2008 financial crisis. A recent report from Challenger Gray and Christmas tells the story. In January, companies announced over 108,000 layoffs, a massive 118% increase year over year. Think about that for a second. We haven't seen layoff numbers like this in January since 2009, the peak of the subprime crisis. Meanwhile, hiring has stalled. Companies only plan to add about 5,300 new jobs, the lowest January hiring record since they started tracking the data in 2009. Surging layoffs and a hiring freeze, that's a scary combo. It confirms the fears sparked by the weak ADP report we saw on February 4th. Remember that? Private payrolls only added 22,000 jobs, way below what everyone expected, and most of that was just in healthcare and education. Core sectors like manufacturing and professional services are actually shrinking. The structural cracks in the economy are wide open. The economy is cooling off, and the shadow of a recession is getting longer. Normally, a bad economy means rate cuts, which makes gold go up. Why is it different this time? Enter the second trigger. The news that Trump nominated Kevin Warsh as the next Fed chair. This news completely flipped the market's easy money expectations. Who is Warsh? He isn't a friendly central banker like Powell. He's known for wanting higher interest rates and a smaller Fed balance sheet. He's a hawk who thinks the Fed is too bloated and needs to cut back. This forced investors to delete their hopes for aggressive rate cuts. They're worried that even if the economy slows down, a Warsh-led Fed will stay tough. We can't count on the Fed to just print money and save everyone like they used to. In fact, he might actively pull money out of the system. The economy needs cash, but the new boss might be tightening the tap. That's like a roof leaking during a thunderstorm. This created a panic over a liquidity drought. The market lost its Fed safety net and everyone started running for the exits. Of course, there's a more basic reason too. Whether it's crypto, tech stocks, or gold and silver, the gains leading up to this were huge. Prices had reached a point where things were objectively overbought and expensive, even if we liked the assets. The market was like a rubber band stretched to its limit. When things are that tight, any bad news, even a small rumor, can snap it. It triggers a wave of profit-taking, which leads to a cash crunch, which leads to a full-blown stampede. In the chaos, big money only cares about two things: US dollars and US bonds. It's the cash is king playbook. We've seen the dollar index surge this week, hitting a 2-week high near the 98 mark on Thursday. A stronger dollar puts immediate weight on gold and silver because they are priced in dollars. It's making a bad situation worse. It's a classic negative feedback loop. Fear leads to selling, selling leads to lower prices lead to margin calls. Margin calls lead to forced selling, which drives the price down even more. That is the liquidity shock we just lived through. Now, I know what you're really thinking. Wang Jin, what happens next? Is this massive dip an opportunity to get rich, or is it a trap? How should a regular investor play this? This next part is crucial. It's your survival guide for the coming weeks. First, I need to give you a reality check. Like I said yesterday, the easy days of gold just going up while you sleep are over. High stress, high volatility moves are the new normal. You need to be mentally prepared. The liquidity crisis isn't over. and you can't just sleep this one off. The market needs time to process the fear. It's very possible we see more sideways chopping or even a deeper drop. Don't assume the bottom is in just because we had one bad day. The metals market is currently in high sensitivity mode. Gold is reacting to every headline, a bit of geopolitical news or a hawkish comment from a Fed official, or even a tiny bit of economic data, can send gold on a roller coaster ride. If the dollar stays strong, gold is still at risk. If the liquidity crunch doesn't ease up, gold might test even lower levels. If you're a short-term trader, you have to shift your mindset. You cannot use a one-way trend-following strategy here. In this market, the trend flips in a heartbeat. 1 second, we're mooning. The next second, the floor drops out. But if you're a long-term investor who follows the big picture like I do, here's my take. This crash is likely a deep reset within a massive bull market, a rare chance to position yourself for the long run. Why? Just look around. Has global uncertainty gone away? Have central banks stopped hoarding gold? Is the world back in love with the dollar? Is inflation truly dead? The answer to all of those is no. As long as those pillars are standing, gold's foundation is rock solid. So, a big drop isn't a signal to run away in fear. The big market moves haven't fully played out yet. There is always another rebound or reversal on the way. It's a signal to get in position. The story for gold and silver is far from over, and after the storm usually comes the biggest opportunity for wealth. But a word of warning about your mindset. The people who lose the most are those who chase the green and sell the red. If you overtrade, the fees and the bad entries will eat your account alive. Gold is likely entering a wide range phase. That means it'll bounce up and down without a clear direction for a bit. If you buy because you think it's soaring, it'll probably drop the next day. On the weekly chart, gold is still technically in an uptrend, but the shooting star candle from last week shows the market is very divided. Short-term geopolitical risks will keep gold from falling too far, but Fed hawks will keep a lid on the price. Watch out for the wind changing. If there's a sudden peace deal in the Middle East, or if the Fed goes full super hawk, gold could have another leg down. Here's a trick I use. It's called contrarian thinking. When the drop makes you doubt everything and you feel like you have to sell and everyone else is panicking, a bounce is usually right around the corner. Conversely, when everyone is euphoric and calling for $6,000 gold, that's usually the top. Finally, I want to hear from you. What's your take on this wild volatility? Do you think gold is topping out and about to crash? Or is it just getting ready for the next leg up? Did you get shaken out of your position, or did you use the dip to buy more? Leave a comment and let's talk strategy. As always, this is just my personal observation and logical take. None of this is specific financial advice. Trading is a game of skill and mindset, and risks are always there. Know your own limits. Think for yourself and make your own calls. If this video helped you cut through the noise, understand the why behind the market, please hit like and subscribe. Share this with any friends who are feeling lost in this market. This is Gold Off the Charts. See you in the next one. Later.